All right, welcome back to Breakout Charts, your weekly drop on the companies and charts I think are ready to break out with potential for huge upside. I'm finding the companies nobody else is talking about and putting them on your radar so you can get in early. This week, we're looking at Devon Energy Corporation, ticker DVN, listed on the New York Stock Exchange. This one is a large cap US oil and gas producer, and in my view, is setting up for one of the more significant technical breakouts I've seen in the energy sector. There's a multi year downtrend which is breaking, the fundamentals are compelling, and there's a transformational corporate event unfolding that I think most retail investors have not really fully processed yet. So, in this video, I'll cover the sector backdrop, the company fundamentals, and recent performance, and then we'll dig into the charts to uncover why I think it's a candidate for a significant breakout move, including entry and stop loss plan. As always, educational purposes only, not financial advice. So, let's get into it. Let's start with the sector macro backdrop for US oil and gas producers. Now, oil prices have been under pressure throughout 2024 and into early 2025 as the market priced in demand uncertainty from OPEC supply management. But that period of pressure really created exactly the kind of multi year technical base and downtrend in energy stocks that I love to monitor. Because when that turn comes, it usually comes with force and it tends to last. So here's the macro picture I see right now. First, that supply discipline. OPEC Plus has been actively managing output to defend price floors. US shale production growth has slowed materially from its peak as operators have pivoted toward capital returns over volume growth. So the era of drill at any cost shale is over. The industry is fundamentally restructured around free cash flow generation and shareholder returns. And that is a structurally different and more investable industry than the one that existed, say, a decade ago. And we can see from the chart here that crude oil production globally is really set to be flat over the next 5 years at least, and even pushing out to 10 years. There's no real significant growth in crude oil production forecast. But at the same time, we've got this demand resilience that's there in the background. Despite recession fears, global oil demand has really remained surprisingly robust, particularly from Asia and emerging markets. The energy transition is a multi-decade story, and hydrocarbons remain the backbone of global energy supply throughout that transition. Electrification and that AI infrastructure build out ironically requires more near-term energy and not less. And again, this chart shows that really liquid fuels, even out to 2050, are projected to be the key source of energy production for globally. Whilst you've got natural gas slowly climbing, coal remaining resilient as well, even nuclear not really projected to make a huge difference, and then obviously other contains some of the green energy build out projected to increase through to 2050. So the third thing that's kind of going on right now is obviously the geopolitical risk premium. So supply disruption risk remains elevated across multiple producing regions. And I thought this site, the Global Conflict Tracker, sort of spells that out nicely. Interesting resource where you can sort of move around the world and see where the current crises and conflicts are taking place. And obviously, the big one on everyone's mind right now is the Iran war with Israel and the United States. So, any escalation or further sanctions, OPEC cuts beyond current schedules can really move oil prices sharply higher and very quickly. And that risk premium doesn't disappear quickly. And that's definitely what we're seeing as the case with obviously the Strait of Hormuz and really the fact that there's been consistent oil removed from production that's really not reflected in the price right now. The fourth thing, and I alluded to this earlier, that's on the horizon, is that we've seen a real multi-year breakout in the chart for XOP, which is the ETF for oil and gas exploration. We can see the downward trend line since 2014, so over a decade there, a number of bounces off that trend line through 2023, 2024, 2025. Um, then you can see that recently we popped out of that downward trend line in 2020, late 2025. And now, as we go early 2026, we've really popped out of that base that's shown by the semicircle base there. So, with all this as the backdrop, when that sector starts to turn, and it is turning now after this prolonged correction, quality names within that tend to move the most and the fastest. And Devon is definitely one of those quality names that I see. In terms of the US energy sector, there's no longer term structural angle worth understanding than the United States, which is in the middle of a genuine energy renaissance. LNG export capacity is expanding rapidly. Europe continues to need US LNG to replace that Russian supply that's come out. And of course, you've got the AI data center build out, which I covered in more detail in last week's Iron episode, is creating incremental baseload power demand that natural gas is uniquely positioned to meet. It's reliable, dispatchable, and available at scale in a way that renewables alone just can't cover. And that's exactly what data centers need, is that reliable power. So Devon Energy is not just an oil story. It has a significant natural gas and liquids production alongside its oil. And that diversification across all three commodities means the company benefits from multiple tailwinds simultaneously. So the broader point is this: the energy sector has been out of favor with generalist investors for a long time. Valuations remain compelling relative to earnings and free cash flow. And when generalist money rotates back into energy, and the technical picture I'm about to show you suggests that rotation may be beginning now, the stocks that have already broken their downtrends will be the first and biggest beneficiaries. That rotation tends to last 12 to 24 months when it starts. And that is the time frame I'm really looking at with Devon. So now let me get into Devon Energy, specifically because this is a company with a genuinely strong fundamental profile and a major strategic development unfolding that significantly changes the scale and quality of the business. So Devon is one of the largest independent oil and gas producers in the US. It's listed on the New York Stock Exchange. Its primary operations are the Delaware Basin and in the Permian, which I'll come back to in detail, alongside the Anadarko Basin, the Powder River Basin in Wyoming, and also it's got operations in North Dakota as well. But the Delaware Basin is really the crown jewel. It's widely regarded as the highest quality sub-basin within the broader Permian. It's got the best rock, the best well economics, best productivity per dollar of capital invested anywhere in the US onshore oil and gas market. And Devon has systematically been increasing its high grade returns within the portfolio to concentrate capital there because the returns are simply superior to anywhere else within the portfolio. On production, Devon has been delivering consistent volumes in the range of 300,000 to 350,000 barrels of oil equivalent per day. And you can also see the financial model that Devon runs is genuinely differentiated in terms of they've reduced their capital spend significantly and improved that capital return to shareholders. They've pioneered what they call the fixed plus variable dividend framework, which basically provides a conservative fixed base dividend that is sustainable even in a low oil price environment, with a variable component layered on top, directly linked to excess free cash flow each quarter. So when oil prices are high and cash flow is strong, shareholders receive substantially more cash versus when prices soften, the base is still protected. Now let's talk about the three main margin metrics that we always like to include. And that is the gross margin for Devon is running at approximately 55 to 60%. To put that in context, the average gross margin of the S&P is roughly 45%, so significant improvement there. In terms of operating margin, they're running at a 25 to 30% range at current oil prices, And of course, if we see oil prices improve, that operating margin will increase substantially. And then the net income margin of around 20 to 25%, consistent with the operating margin, is proof that the business is in good shape. Compared to the S&P average net margin of around 11 to 12%, Devon's underlying net margin is genuinely competitive, even after you consider the capital intensity of the business. So the critical trend across all three margins is stable and improving as Devon concentrates capital in the Delaware Basin. It's reducing unit production costs, and margin expansion in an environment of steady or rising oil prices is a fundamental tailwind over the next 6 to 12 months at least. So now let me quickly talk about the Coterra merger, because this is the development that I think genuinely changes the scale and investment case for the Devon Energy and deserves some serious attention. Devon and Coterra Energy have announced a definitive agreement to merge in an all-stock transaction. So why is this important? Well, first is scale. The combined company will have a pro forma production exceeding 1 million barrels of oil equivalent per day. Second is Delaware Basin dominance. The merger creates a leading operator in the Delaware Basin with a pro forma third quarter production of around 600,000 barrels of oil equivalent per day from that basin alone. And we've already talked about why that is so important. Third is just the synergies. The companies expect to achieve $500 million in annual pre-tax synergies alone. These come from three sources: an optimized capital program in the Delaware Basin, operating margin improvements from scale and efficiency, and streamlined corporate costs. Fourth, there's the shareholder returns. The combined company has committed to a planned quarterly return of capital exceeding $1 billion. Still subject to board approval, but we expect that to go through. Fifth is the all-stock structure, which is important. The deal adds no new debt to the combined balance sheet. It's all in stock, so both companies maintain investment-grade financial strength. And sixth, there's technology and data-driven optimization, because both Devon and Coterra have strong AI and data-driven operational capabilities. So the combined technology and data platform is expected to accelerate capital efficiency improvements above and beyond the strategy synergy numbers. So with all that said, all in all, what do we have? We've got the overall sector improving, with energy macro turning, supply discipline holding, demand is resilient, and we've got that geopolitical premium, which is still persistent. The company fundamentals are compelling. We've got the world-class Delaware Basin acreage. We've got above sector average margins on all three metrics, disciplined fixed plus variable shareholder return framework, and a clean balance sheet. And finally, that transformational catalyst, the Coterra merger, which creates the premier large cap US shale operator with $500 million of annual synergies, over $1 billion per quarter in capital returns, and no added debt. So let's take a look at the charts and see what's happening there, and if we can see the fingerprints of all this activity when we take a look at the longer term charts. We've got our usual four screen setup. Bottom left hand corner the monthly, bottom right hand corner the weekly, top right hand corner the daily, and top left hand corner go back to the weekly to take a look at the RSI and the average true range. On the monthly, weekly, and daily, we've also got the MACD, and we've got the ADX as well, the ADX indicator. So, as we always do, starting on the high time frame, looking at the monthly, what we've got here is obviously a continuous downtrend through from 2008 right the way into 2020, when we had the COVID low in 2020. And then since then, we had a significant climb into the top at around $80 there. That peaked back in 2022, followed then, since then, by this persistent multi-year downtrend, with the price grinding lower through a clearly defined descending channel, which we've shown here. Lower highs, lower lows for a 3-year period. And that pattern is what's kept the majority of investors completely out of this stock, and it's exactly what's created this opportunity. And we can see by this lower volume all the way down here, we can see that from that peak in 2022, that the ADX has really cooled off. But interestingly, the red DI line really has struggled to get anywhere above the 25, showing that there was not really significant selling throughout that period. And we've also seen that the MACD has swung down lower into the base of that channel. And now what we saw in early 2026 here is the cross as the MACD has turned up into positive territory. So what we've seen is that price has broken above the upper boundary of the descending channel. And when you see a multi-year channel break like this on a monthly time frame, it does signal a genuine shift in the long-term supply-demand balance of the stock. The sellers who controlled the price previously have lost their grip, but all the while we can see that really we didn't see significant breakout in the sellers during that time. So the key prices I'm focusing on a monthly time frame are in this $42 zone around here. We can see that that's where the breakout occurred and the top monthly candle closed. A monthly close convincing from here above the $50 level will really start to confirm a significant breakout, with the next meaningful resistance not until we get up until this $60 area, and then from there onward to all-time highs. With the Katera merger expected to close Q2 2026, so anytime in the next couple of months, and 500 million of annual synergies beginning to flow through over the next 12 to 18 months, this fundamental story and the technical story are aligned for this monthly time frame to really push on. So that's what we're seeing on the monthly. Let's drop down to the weekly, and this is where the sequence of technical events that confirms the setup really plays out. That descending trend line from the 2022 peak. We've seen a clean break with a strong range expansion. We've also seen the volume come in here. This is the first and most important step of the sequence. We then saw we got this, if you're into your candlesticks, we've got this tweezer top that came in late March. The price then pulled back into this $42 region. And then what we've seen is that there's kind of really quite a shallow, orderly, perfectly controlled pullback here. And now what we're seeing is that we've got this big, large candle that's come in recently. On the other indicators, the ADX is continuing to rise up through the weekly. The MACD is cooling off, but it's coming in for this really nice squeeze on the MACD here. And what we're looking forward to seeing is a nice stretch away as the MACD bounces off of that. When we look at the RSI, we can see that the RSI is really, we got that lovely breakout off the channel. But then we can also see that we did get overbought slightly on the RSI. That caused that top, that mini top that we've had there. We've now had this nice orderly pullback. It's really great to see this big long wick into that $42 area that I mentioned. The RSI on the 20, only got down to that 43 range, and the RSI on the 5 couldn't even get down to the 50. And now that we've seen that the RSI now progressing upwards, all the while the average true range has been expanding on this breakout from the chart and up into that most recent top. Finally, finishing on the daily, and what I do want to make it clear here is I use the daily really for timing the entry and defining the precise exit. It's really not about the overall thesis, which is clearly built out on this monthly and weekly time frame. But if we do have a look at the daily, what it does confirm is quite straightforward. Price has had a strong impulse move higher after breaking out of that multi-year downtrend. We've then seen the MACD has really increased into that top. We had that top at around about that $52 level. We've now seen this nice orderly pullback, which we can see. I've also got the zigzag on here that's sort of shown that we've had that pullback into this as to be expected range of around $42, and we can see that's exactly where we would like to have seen that. Providing support just around that $42 range. We've had the bounce there. We've seen the MACD starting to curl up, which is exactly what we want to see. A clean reset and a re-entry signal that sits within the broader weekly and monthly uptrend structure. Prices above all the key, it's pulled in above the key moving averages, and I've got the 40 and the 18. The 18 is the faster moving average. I just like to use that over the 20 because it does provide the signal a bit quicker. So as always, this is purely educational advice, but this is a really nice setup. We've got the monthly breakout. We've got the weekly confirming everything with a nice orderly pullback. We've got the MACD showing that we're actually coming in for a pinch on the MACD, and we should see that then expand out on the weekly, which is shown to us by the fact that the MACD on the daily is also showing that it's pulling up now out of that pullback. So all in all, I hope you've got some value from this. And if you did, make sure you please give me a like, subscribe to the channel, hit the notification bell so you see more videos like this. I'm dropping them every week. So wrapping it all up, Devon is a high quality company with above average margins on every metric. A transformational stock mergers coming in to create the premier large cap US shale operator with 500 million of annual synergies and over $1 billion per quarter in committed capital returns. We've got a chart breaking a 3-year downtrend convincingly for the first time, and a sector backdrop that appears to be turning in energy's favor after years of underperformance. So for the patient, disciplined, longer term investor, I think Devon Energy deserves serious attention right now.